Investors often shout buy the dip during market turbulence. This popular strategy encourages purchasing assets when prices temporarily fall. The philosophy suggests that quality stocks eventually recover, rewarding those who capitalize on discounted prices during downturns. It transforms fear into opportunity. Understanding key terminology helps navigate these movements. Bull markets signify sustained price rises and optimism, while bear markets describe prolonged declines. Volatility measures price fluctuations, and diversification spreads risk across different assets. Mastering this vocabulary is essential for any budding investor. While buying the dip can reward patience, it carries significant risks. Market timing is notoriously difficult, and falling prices can continue longer than expected. Always research fundamentals before investing. Never commit funds you cannot afford to lose, and consider professional financial guidance. This video is for educational purposes only, not financial advice.